Alright, welcome to the channel everyone, it's Nick Armenis here, and in today's video I'm going to cover off what I think are the best ASX stocks for June 2021. I do apologise, I've been a little bit slack in posting videos of late, but I've been really busy. I do have a blog that is about to launch on this, so it'll be kind of similar to the Motley Fool, but hopefully much better content. So stay tuned for that, I'll release it very soon. So guys, I'm going to cover off the themes and what's going on in the stock market, what I'm doing to position myself for the future. If you do enjoy this content, guys, please smash the subscribe button and hit that notification bell. Also, really appreciate if you give the video a thumbs up and let me know in the comments below what you thought of the stocks I've talked about, what you're doing, and what's going on with the channel. I know a lot of you sometimes come here just to kind of get some ideas. So this is what I'm trying to do with this style of video. As always, I'm not a financial professional, guys. Some of you have been smashing me saying I'm obviously not an expert. Obviously not, guys. And to be honest, if you're doing the bulk of your research on YouTube, that's not a great place to do in-depth research. Most of the research on here is absolute rubbish that I see on YouTube. There's a select few people that are doing a really good job, and I'm trying to lift that standard. If you don't agree with my ideas, please let me know. I'm all open to other ideas, but yeah, please just use this as a starting point for doing your own research. So guys, the theme of the month. What I'm seeing at the moment is we're in a period of a tug of war. The market can't decide whether we're going to go back onto risk on to where we were with, high-tech names going up, Bitcoin, cryptos, and really high PE stocks doing well, versus is there inflation, value stocks, cyclicals going to do better? And it seems to be a bit of a tug of war between the two. That's what I've seen probably the last 2 months. So how am I playing this? What am I expecting? So I did rebalance my portfolio around 3 months ago. I did mention it to you. I've basically had a slightly less of a growth tilt. I'm still primarily looking for companies that are going to grow their earnings over the long term, and especially ones that are going to do it quite rapidly. I do like that. I'm still quite young. I'm 31, so I'm not having a super conservative portfolio, but I have kind of rotated out some of my super speculative names and gone to a bit more of a balance with introducing a bit of value into there. And introducing a bit of cyclicals as well. I will note that I invest a lot of my money into the US markets. I still have probably 50-50 between the two, but I am constantly probably pushing more to the US side, particularly for the exciting growth names. There's just way more there. And I recommend that you do get some exposure, at least through ETFs, to the USA. I will say, guys, I'm not panicking about inflation, but I do obviously see it picking up. You see it in your grocery prices, you see it across the board in building materials, car prices, things like that. So prices are definitely going up. Here's the but. The but is that you need to see strong wage inflation to be really worried about inflation. So until I see that, I'm not going to be too worried. Definitely going to position myself to, in the event that something happens, I have some exposure. But overall, you still want to be invested in the markets when inflation occurs, because the value of your money is going to drop, and assets will continue, or at least should be better inflation hedges than, say, cash. Real estate will do well during this period as well. So if you do have exposure to that, then awesome. As I said, I introduced more value and I've traded in and out of recovery. The speculative recovery, I think, has had a good run. I was trading in and out of it during, lockdown news, whatever was happening. I got into things like Expedia, Flight Centre, Sydney Airport, but I'm out of all of those at the moment. Potentially there's another good period of buying, say if there's more lockdowns and things like that. But overall, when I see super speculative not super speculative, but when I see Expedia and things like that trading back where they were pre-COVID, I get a little bit worried, because I still think that the environment for these stocks is still a little bit uncertain. Ones that have domestic exposure, I'm still interested in. Particularly ones that have got strong domestic exposure, but I'll get to that in that section of this video. Value is still good in my view. Banks, energy, mining, cyclicals, but they do seem to be coming off a little bit, and growth names are starting to look more attractive in my view. I still think gold miners are very cheap, especially US-based ones. And I think we're due for a small correction probably in the next month or two. Obviously, I've got no idea when it would happen, but I think the overall market's trending upwards, and I wouldn't be surprised to see a small pullback very shortly. That would just create a buying opportunity, guys, for things like gold miners. So I think gold miners at the moment are a pretty attractive looking investment from my point of view, and I have quite a large position in Northern Star, full disclosure. So the best way is to get exposure to this, and I will go through my investment thesis after telling you which stocks I'm looking at, only because I know a lot of people want to see the stocks first and then the reasons. So if you want a relatively larger or safe play on this, go Northern Star, or even safer, Newcrest, NCM, for maximum safety. If you want a little bit more speculative, but still kind of, some decent upside, Evolution Mining, ASX, EVN. Mid cap, so I do these ranked because it depends on your risk level. Like if you're wanting, exposure to this, go the larger ones. If you're wanting more upside, you'd probably want to get some exposure to the mid and maybe the smaller high risk names. You wouldn't want to put as much money in the higher risk names, okay? So mid cap, I'd look at something like Regis Resources, RRL, Silver Lake, SLR, or St. Barbara, SBM. For, I guess, even more smaller, higher risk names, but potentially larger upside, potentially larger downside as well. Bellevue Gold, BGL, Resolute Mining, or Anglo Gold, Ashanti, ASX, AGG. So going smaller than these for me is rife with trouble. So I've probably cut it off there around the $500-600 million market cap level. I know a lot of you are willing to take on more risk than that, but me personally, I'm just not. It's not something that I am interested in at this stage. I don't need to be. I can make good returns with less risk on these other names. So my investment thesis for the gold miners, gold is one of the only commodities that has not yet fully run during this commodity super cycle. So as we've seen, iron ore, copper, lead, zinc, all these different commodities have done really, really well. Gold hasn't really run anywhere near as hard as those. It did last year, probably got a little bit ahead of itself. It pulled back, and it seems to be on the up again now. Gold miners have cut costs and margins are really strong. So they're leveraged to the gold price, anywhere from 2 to, on the smaller ones, maybe 10 times leverage. So what I mean by that is, so if there's a 1% change in the gold price, Northern Star might be up or down 3 or 4%. Okay, so they're leveraged to that gold price. It's almost like taking on leverage without doing so. They're now cash generating machines, guys. They're making a ton of money due to these stronger margins, still relatively good gold prices. They had a period where, they stripped out all the costs of their business and they're doing really, really well. So even if higher gold prices do not eventuate, they're still trading on really attractive valuations. And that means, in my view, that, they're starting to look like really, really good, even almost like a value play. This bull market has occurred in segments, so it seems likely that eventually these, it'll spread out to these gold miners, which, have been hit pretty hard. Some of them are down quite a bit. And so once, as I've said to you, this bull market, it went from growth names to value names, cyclical. And as it branches out, I think gold may be the next one to benefit. So you may want to get some exposure there. As always, just my view, guys. The next kind of area I still see good upside is energy, particular oil and iron ore stocks. I think are still looking pretty attractive. So best ways to get exposure, I still think that beta shares, global energy ETF is a good one. Let's get into the plays I think are good for energy and iron ore stocks. Okay, so the best ways to get exposure, I've mentioned this before, in my view, is the Fuel ETF by Beta Shares. So it's the Global Energy Companies ETF, currency hedged. I've got the link there. I like that as a broad play on oil. Woodside Petroleum is another one that's relatively safe. And then if you want to get a little bit more riskier, go to something like Origin or even, Santos, Oil Search. For iron ore, safer players, I see a BHP and Rio, particularly BHP. If you want slightly more risk, potentially more upside, Fortescue Metals, Oz Minerals, or Min Resources. So guys, I try to select the companies that are in good financial positions so that you don't take on too much risk. That's basically what I do in these things. My investment thesis on these two areas, guys, so oil prices at 15-month highs. Obviously, higher oil prices means that these companies will make more profit and therefore will experience better share prices. Most of these businesses have embarked on massive cost-cutting programs, guys, which means that their margins and their profits are going to dramatically improve, which makes them better businesses. The push for green energy has led to huge underinvestment in oil, obviously for a reason, but I think that it's massive underinvestment and it's going to cause a temporary spike in prices. Remember that this is a trade, not a long-term hold, because I don't think the long-term future for oil is fantastic with the push to EVs and more renewable forms of energy. So this is a short to medium term trade, but one that I really recommend you get exposure to. I got out of this trade way too early. I made good money because I bought it near the bottom, but I still think it's a good one, particularly if it pulls off at any point in time. And then iron ore, still in huge demand. Brazil still hasn't come fully online. Prices well above analyst forecasts. There's obviously still the China risk there that that they put tariffs or stop buying, but it's a key ingredient in recovery, and government infrastructure programs, building and stuff like that in this recovery will push this demand and push prices up, right? Miners are still trading at attractive price to earnings ratios. They're trading at attractive levels. They've got, interest rates are still low, so they can keep borrowing, and also dividend yields are still pretty solid on these businesses. So definitely worth getting exposure to this industry. The next area I'm looking at is banks and insurance. So banks a little less so. They've had a pretty good run, but any increase in rates from here will be positive. Dividends look to be returning. Technicals are looking great for them, and with dividends returning because they were quite cautious, this should push more demand for these stocks. The MVB ETF kind of gives you broad exposure to all the banks. Otherwise, you've got the big four, CBA, ANZ. Any of those will do. Macquarie is looking a little bit expensive at the moment, but still, it's a good business, so I wouldn't be too worried. It should still do well. But yeah, it's starting to look a little more expensive. As I said, insurance for me here is probably the standout and one that could be a good buy at the moment. It should be performing similar to banks with what's going on. In the US, the insurers have done fantastic. Here, not so much. So obviously, we do have natural disasters and stuff like that occurring. But if this year's a solid year, no major disasters, underwriting's good, profits should be really good. I like IAG, but QBE is another good option here. So my investment thesis for those was pretty obvious. I went through it there. Inflation, low interest rates, things like that. So the next one would be consumer discretionary and domestic travel. Something like an ARB, ASX ARB, anything 4x4, camping, caravanning has been doing well, which is also why I'm saying something like a super retail group might be good to look at. Similar to the above, you've got BCF, super cheap auto in there. It's obviously going to be a little bit more risky because it's a different play. National Time Wheel is something I've been looking at lately. Might be one I do a bit of a deep dive on. ASX NTD, more driving means more tyres that are going to be used. So not a company a lot of people hear about, so it might be one of those hidden gems. Then we have things like a Domino's Pizza, ASX DMP, more people eating at home, particularly with the Victorian lockdown. So Domino's should benefit from this. AP Eagers, you got ASX APE, more car sales, pretty simple. People are going crazy for cars at the moment. Ceiling travel, domestic tourism play has been doing really well now. I don't know if it's run too hard, but still one I'd look at. And then car sales. So secondhand car sales are doing fantastic. Look at the madness occurring in the USA. When stuff like this happens, guys, even if you don't get in early, if it's still occurring, could still be a really good time to get in. The thesis here is pretty simple, guys. We've got international borders closed. Australians are spending big on domestic holidays. Australians spent a lot of money overseas when the borders were open, more than international visitors spend here. So people are spending big. People have more money than ever because there's been stimulus. Most businesses are doing relatively well, despite lockdowns and things like that. Other than hospitality and tourism broadly, domestic tourism is doing quite well. If you look at what's going on out there, most people are fully booked out, and you've got low interest rates. People can invest. People's mortgage repayments are relatively low. So, Australians are doing pretty well. So consumer discretionary in those environments does quite well. Camping, 4x4 and caravanning has been incredibly popular. Just try and find a van or camper trail at the moment, guys. Its prices are crazy. Just go and have a look. So the last thing I'm looking at, I haven't covered this off in as much detail because I want to do a full video on it, is growth at reasonable valuations. Okay, so I believe Goldman Sachs, Morgan Stanley, something like that has coined this phrase now. But that's what I'm looking at. I'm looking at things that have been, that were growth plays previously that have been beaten down really hard. Things like online retailers. I think these have been beaten down exceptionally hard. There's obviously a reason they ran up too high. Online sales pulled back a bit. But to be honest, the trend is still in their favor. And I think, over the next 2 years, these will do return to doing phenomenally well, like even Kogan, My Deal. But ones like Satir is still doing fantastic. Dusk is doing really well. Not so much an online retailer, but it's growing there. And also Adore Beauty. So I tried to mix in some retailers that are doing really, really well, like Satir and Dusk, with also potentially getting some exposure to the beaten down ones as well. Selected tech is looking good in my view as well. So things like Altium, Appen's a bit more risky. We don't know what's going on there. I have a position in Appen, a small one, but potentially will look to increase my position there if things start going well. If not, then I'll cut my losses and move on. Pushpay Holdings, in my view, is a very interesting looking play, guys. It's growing really, really fast. One company I've been looking at recently, are People Infrastructure and Healthier Limited. So People Infrastructure is labor sourcing, should continue to grow in a big way. It's, it doesn't get as much attention as some other stocks. It's got a cheap multiple, so it should expand. And then I'm looking at Healthier as well. I'll cover these two in a different video, guys, just because they need a bit more attention, and obviously to cover them off in detail will take some time. So Healthier, is a allied health businesses. It goes and buys these different, podiatry clinics and things like that, and it rolls them up into its own brand, and it continues to go into other areas of health as well. So it's got a really strong growth outlook. Yeah, definitely worth taking this view and seeing if you can find more of these reasonable valuation growth names. Because I think there's been some stuff that's been unfairly beaten down, and this might be an area where you can find more stocks to invest in. So as always, guys, I hope you've enjoyed the content. Please subscribe, hit that notification bell, and give it a thumbs up. Hope you've enjoyed the video, and I will see you in the next one.